Picture a street with 5 businesses on it. A coffee shop, a salon, a little design studio, a print shop, and then on the corner, a regional bank and a glass tower. Somebody walks up and asks you a simple question. What is the average revenue of a business on the street? So you add them all up, you divide by 5, and you get something like $575,000. Sounds healthy. Sounds like a street full of winners. Except 4 of those 5 businesses earn about $120,000 a year. The only reason the average comes out to $575,000 is that the bank on the corner pulls in $2.4 million and drags the whole number up with it. That average describes a business that doesn't actually exist on the street. Not one of those 5 owners would recognize it as their life. And here's the rule I want you to carry into every conversation this year. Whenever someone hands you an average, go looking for the outlier, because one big number can hide 4 true ones. The IRS understands this better than anyone, by the way. It's the whole idea behind benchmarking. Your client's return gets quietly compared against a curve, and when their numbers drift out to the edges of that curve, that return starts to look a lot more interesting to the person reviewing it. But here's the part that matters for today. Your clients do this exact same thing to themselves every single day with one number. They run their entire business off the balance in their checking account. They see cash, they feel rich, they pull it out, and after a few months, they realize that they've been blindsided. The one number is hiding the real story from them, and you might be the only person in their life who can tell them what it actually says. Hey friends, welcome to the Thrive Advisor podcast, where we help tax advisory firm owners build practices that are sustainable and profitable. I'm your host, Aaron Siegel. Let's start with something that I think gets lost in our profession. Your client was never taught how to read their own financials, and I don't mean that as an insult to them. Financial statements were designed by accountants for accountants. They're technically correct and almost completely unreadable to a normal human being who just wanted to build a business that they love. So your client opens the report, their eyes glaze over, they nod like they get it, and they go right back to checking their bank balance. They're not bad at this. Nobody ever explained it to them in a way that made sense. Now, here's why this is the most important skill you can build right now. AI is going to keep eating the compliance work. The data entry, the categorization, the document matching, eventually a lot of the simple returns. And honestly, that's fine because that's never where our value lived. Our value lives in the conversation, in the translation, in sitting across from a client or on a Zoom with a client and telling them what their numbers actually mean for the decision they're about to make. A machine can produce the report. It can't read the look on your client's face when they realize the money is not where they thought it was, and it can't decide what to do about it. And yet the mistake I see advisors make constantly is this. They generate a beautiful 12-page management report, they email it over, and they hope for the best. The client opens it, feels a little stupid, files it in a folder they're never going to open again, and absolutely nothing changes. That is not advisory. That's just a data dump with a cover page. So today I want to give you the single highest leverage version of the client conversation, the one I would start with almost anybody. It's the difference between profit and cash. And along the way, I want to get you thinking about which 2 or 3 numbers actually deserve your client's attention instead of all 15. Because being an advisor is not about showing clients everything. It's about pointing at the few things that matter. So let's make the profit and loss statement simple, because simple is what makes it usable in a real conversation. So P&L answers exactly 3 questions. What came in, what it cost to deliver, and what it costs to run the place. So question 1 is revenue. What came in the door? For a course creator, it's course sales, the membership dues, the affiliate income, the sponsorships. Question 2 is the cost of delivery. So what did it actually cost to deliver the thing you sold? So this is the piece that most creators have never separated out. For a course business, this is your platform and processing fees, your affiliate payouts, the contractor who edits the videos, the support person answering student questions. These are the costs that only exist because you made a sale. Question 3 is your operating expenses. So what does it cost to keep the lights on, whether or not you sell a single thing this month? Your software stack, your virtual assistant, your own pay, the subscriptions you forgot you had. And let me make this concrete. Say your creator sells $200,000 in courses and memberships this year. So that's revenue, question 1. Now the cost of delivery. So the course platform's taking a cut. The payment processing takes a couple percent. Affiliates got paid out and a contractor edited the content. So we'll call all that $50,000. So the business kept $150,000 after the cost of actually delivering what they sold. That number has a name, which gives us gross profit, and we're going to spend a whole episode on it next time. Then question 3, the cost of running the place. So all the software, the virtual assistant, the owner's pay, the subscriptions, call that 110 grand. So what's left is net income, which would be 40,000. So that's your profit. 3 questions, 3 numbers, and a clear answer. Everything else on that report is just the detail living underneath one of those 3 buckets. And when you hand a client those 3 questions, something clicks for them. For the first time, they can hold their whole business in their head at once. So what came in? What did it cost to deliver it? And what does it cost to run the place? That clarity is the thing you're actually selling, not the report. It's the understanding. Now, here's the catch. Knowing those 3 numbers tells you whether the business is profitable. It doesn't tell you whether there's any money. And that gap is where almost every client gets into trouble. Here's the pattern I see more than any other across basically every creator and membership client I've ever worked with. They live out of their bank balance. I've watched this play out more times than I can count. A creator comes off a big launch year feeling like they finally made it. The account has never looked healthier, and nobody in their life has ever taught them that a full bank account in the spring is not the same thing as the money they get to keep. So they spend the year reacting to that balance, and by the time they land in my office, the launch money's gone, tax bill's sitting there, and they genuinely don't understand how a year that felt so good left them this stressed. They didn't do anything crazy, they just trusted the wrong number. So let me paint a picture for you. A creator has a good year. Let's just say the P&L shows net income of 40 grand. On paper, they're profitable, and they can feel it because most of the time there's money sitting in the bank account. So they start treating what's left in the bank account like their personal wallet. The balance looks good this week, so they buy the new laptop. Balance looks good again, so they bump their pay. Looks good another time, and then they take a distribution and book a trip. They're not being reckless in their own minds. They're looking at a real number. It's a number that's right there in the app on their phone, and that number says there's money. What they never do is set anything aside. Not for the tax bill that's coming, not for the annual software renewals that all seem to hit in January, not for their quarterly tax estimates, and definitely not for a retirement contribution, which is the thing that would actually build them real wealth and which they keep meaning to get to next year. So they're reading exactly one number, the bank balance, and I want to say this as clearly as I can. The bank balance is the single most misleading number your client owns. It does not know what they owe. It does not know what has been cleared. It doesn't know that half of it is belonging to the government. It's just a snapshot of one moment, and they're making every financial decision of their year based off that number. So let's follow that $40,000 of profit and figure out where it actually went, because this is the walk I want you to be able to do live with the client. We're going to make an assumption here and use accrual accounting because sometimes it's easier to grasp, but the P&L says the business made $40,000, so we're starting there. The first drain, some of the revenue might have been billed but never collected. So let's say they have $12,000 sitting in receivables, an invoice to a sponsor, a payment plan that a student's still working through for that annual plan. The profit got counted the day they sent the invoice on accrual, but that's not in the bank. So right away, only $28,000 of that $40,000 in profit would have actually turned into real cash. The second drain is distributions. So over the year, our creator pulled $60,000 out of the business because, remember, they were watching their bank balance, not their actual financials. They felt rich on the weeks the account was full and they acted on it. The third drain is the business sent $15,000 in estimated tax payments to the IRS for their personal account during the year. So let's add it all up. About $28,000 came in as real cash. $75,000 went out between the distributions and taxes. In a year, the business, quote, made $40,000 in profit. It actually burned through about $47,000 of cash. And of course, your client's exact lines will be different. But I promise you, the shape is always the same. The profit number and the cash number tell 2 completely different stories. And this can also apply quite a bit in the course creator community when they're selling annual products, but they're realizing that revenue monthly. There can be a big disconnect in what they see as sold and what cash is actually coming into the bank. And here's the cruelest part of this whole thing. The part that makes this an emergency and not just an accounting curiosity. The tax bill is still calculated on that $40,000 of profit. So it's not on the empty bank account. Next April, they're going to owe real money on income they genuinely can't find because they already spent it, gave it to themselves, or are still waiting to collect it. That's the moment they call you in a panic. and it's the first time you're having the conversation. And if that's in April, you're too late. This is an October conversation. This is a September conversation. This is the whole reason that the set-aside discipline matters so much. Knowing the infrequent expenses, the renewals, the quarterly taxes, the retirement contributions, none of it survives contact with a checking account that your client treats like a wallet. The money has to be moved out of sight before they can see it and spend it. And I'll be honest with you, I learned a version of this in my own business, not just from clients. When I started my practice and it scaled faster than I expected, I had months where the account looked great and I thought I had it all figured out, and other months where I could not figure out why a profitable business felt so tight. The numbers on the report and the money in the bank were telling me two different things. And until I sat down and actually reconciled those two stories for myself, I was running on the same instinct my clients run on. So when I tell you this is the conversation that matters, I'm not preaching at you from the outside. I'm telling you the thing that I had to learn the hard way, and the thing now I refuse to let a client walk around without understanding. I want to give you a line that you can hand a client because it sticks. Profit is an opinion. Cash is a fact. Let me give you the 4 reasons that's true, because these 4 points are the entire conversation. First, you owe tax on your net income, not on your bank balance. The IRS doesn't care what's in your bank account. They care what the business earned on paper. Second, receivables count as income the moment you bill them under accrual. So you can be taxed on a dollar you haven't actually collected yet. In that same mindset, if they're cash basis, but they're actually selling things annually paid monthly, a lot of times their platforms will act in that accrual method. So they're going to think they've made money that they haven't actually collected yet. And third, owner distributions, they're not a business expense. They don't touch the P&L at all. So a client can pull 60 grand out of the business, see zero change in their reported profit, and wonder why they feel broke. The P&L will never explain that to them. You have to. And fourth, a high bank balance doesn't mean high profit. So sometimes a fat bank account just means you haven't paid your taxes yet. That money is not theirs. So profit is an opinion. It's shaped by timing, by when you bill people, by your accounting choices. But cash is a fact. It's either in that bank account or it is not. Your client needs to be able to read both stories, and right now they only know one of them. And if they only ever read one, the tax season is not a season for them. It's going to be an ambush every single year. So how do you actually do this without mailing them a report they'll never read? Here's a playbook for you. Before your next call with a client, we're going to pull 2 things and put them side by side. The P&L for the period and the actual current bank balance. That's the whole setup. Then you open with one sentence. Here's what the business earned. Here's what's actually in the account. Let's talk about the gap. The sentence does more than any 12-page you could ever send. Then we need to walk the drains out loud exactly like we did. So here's what's still sitting in receivables. Here's what you pulled in distributions. Here's what went to taxes. And you let them watch the money leave. That's the moment it becomes real for them, because now they can see with their own eyes where that money went. And then you install the behavior, because understanding without a system just becomes guilt. The fix is boring and it works. A separate bank account for taxes, funded as a percentage of every dollar that comes in automatically before they can see it. I usually start clients somewhere in the range of 15 to 20% of their gross revenue, depending on their situation. And the exact number matters less at first than the habit of that money leaving the main account the day it arrives. So out of sight, out of spending range. A second line for the infrequent stuff, the annual renewals, the once a year costs. So January is not a shock. And then the retirement piece, which is the one that actually changes their life and the one you're going to have to keep raising, because they will never bring it up for themselves. The beauty of this is that once the set-asides are automatic, the balance they're looking at is finally close to honest. The money they see is actually theirs to use. So you haven't just explained the gap, you have engineered it out of their daily life. Now, on the numbers themselves, you don't need to hand a client 15 KPIs. That is the management report mistake all over again. Pick the 2 or 3 that matter for their model. For most of my creators, I start with net margin and a tax set-aside percentage. That's it. 2 numbers they can actually hold on to. We're going to get into the marketing numbers, things like customer acquisition costs, lifetime value, return on ad spend over the next couple of episodes, because that's where the real depth is once a client can read the basics. But you have to be niched enough to know which numbers matter for the business that's in front of you. The numbers that matter for a course creator are not the numbers that matter for a construction company or a law firm. That's the whole argument for going deep in a niche. And we'll keep coming back to that all series long. But let's bring it home. P&L answers 3 questions: what came in, what it cost to deliver, and what it cost to run the place. But profit and cash are 2 completely different stories, and your client is living off the wrong one, the bank balance, which is the most misleading number they own. Your job is not to drown them in data. Your job is to tell them both stories and to install the simple set-aside discipline that keeps the cash story from blindsiding them. And let me give you some permission here, because I know our instinct is to over-deliver. You don't have to become your client's bookkeeper if you don't want to. You don't have to become their therapist. You don't have to do anything except for have one honest conversation with them about the gap between what they've earned and what they have. That one conversation is worth more to them than another perfectly formatted report. And it's the kind of thing that turns once-a-year tax clients into people who stay with you for decades. It's also, frankly, the kind of work that's going to keep you relevant in the world of AI. The software can generate a statement. It can't sit with a stressed-out founder and help them see their own business clearly. That's yours, and it always will be. So here is your one move this week. Pick a single client, just one, and before your next call with them, pull their P&L and their bank balance and set them side by side. Walk them through the gap. Name the drains out loud, and then watch what happens to the relationship when they realize you are the person who finally made the numbers make sense. If you're ready to build systems with advisors who get it, come join us in the Thrive Advisor Collective on School. The link is in the show notes. And if this sparked a light bulb for you, share this episode with another advisor who's still just preparing returns and wants to start having the conversations that actually change a client's life. You've been listening to the Thrive Advisor podcast. Work smarter, serve better, thrive always. We'll see you next time.